What is a unit trust? A unit trust is a way for lots of people to pool their money together and invest in a wide mix of things, like shares, bonds, or property, all in one go. Instead of buying investments yourself, you buy units in the trust. Each unit represents a slice of the total fund, which is managed by a professional who decides where the money goes. So, it's a bit like putting your money into a big pot with other investors and letting an expert do the shopping. Why does it matter? Unit trusts make investing easier and less risky for beginners. You don't need to know how to pick shares or track markets, the fund manager does that for you. Because your money is spread across many different investments, it reduces the chance of losing everything if one thing goes badly. That's called diversification, and it's a key part of smart investing. They also allow people with smaller amounts, like £100 or £500, to access a wide range of investments they couldn't afford on their own. Unit trusts aren't just for new investors either. They're widely used by pension funds, retirement savers, and anyone looking for a hands-off way to grow their wealth steadily over time. Here's a simple example. Let's say you put £1,000 into a unit trust that holds 100 different companies. You now own a small part of all those companies through your units. If the value of the companies goes up, the value of your units goes up too. If they pay dividends, you get a slice of that as well. And if you want to cash out, you can usually sell your units at the current market price. Some unit trusts give you a choice. Income units, which pay dividends out to you as cash, or accumulation units, which reinvest those dividends automatically. The right option depends on whether you want income now or long-term growth. What else should you know? You can invest in unit trusts through most investing platforms or by speaking to a financial advisor. It's often as simple as setting up an account online and choosing how much you want to invest, either as a lump sum or monthly by direct debit. Like most managed funds, unit trusts charge a fee to cover the cost of running the fund. This is usually between 0.5% and 1.5% per year, and it's taken directly from the fund, so you won't see a separate charge, but it does slightly reduce your returns over time. It's also worth knowing that unit trusts are often actively managed. This means a fund manager is picking and choosing investments with the aim of beating the market. This is different from index funds or ETFs, which simply follow the market and often have lower fees as a result. Although unit trusts spread your risk, they aren't risk-free. The value of your units can still go up or down depending on how the investments inside the fund perform. Some unit trusts focus on lower risk assets like bonds, while others aim for higher growth by investing in riskier companies. When you buy or sell, you'll get the next available price, not the one you see at the time, because unit trusts are priced just once a day. Some funds also have slightly different prices for buying and selling, known as the bid-offer spread, which can mean you get a bit less back if you sell soon after buying. And like most investments, any profits or dividends you make from unit trusts may be taxed, unless you hold them in a tax-free wrapper like a stocks and shares ISA, which helps protect your returns. To sum it all up, a unit trust is a simple, beginner-friendly way to invest in a wide range of assets by pooling your money with others. It's managed by professionals, offers diversification, and helps spread risk, though returns aren't guaranteed and fees apply. For anyone looking to start investing without picking stocks themselves, a unit trust can be a great first step, and one that continues to be used by experienced savers and institutions alike. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.